The world's fourth largest economy, Germany, has entered recession. The United States is trying hard to ward it off, and so are several large economies. But India, which has been called a shining light or bright light, continues to live up to the name. Its GDP growth registered a surprise jump in the fourth quarter of FY23 at 6.1%, on the back of a pickup in manufacturing activity, good agricultural output, and recovery in private investment. With this, the Indian economy clocked a growth rate of 7.2% in FY23. In the previous financial year, that is FY22, India had seen 9.1% GDP growth. In Q3 on FY23, the GDP growth rate was 4.5%. It was 6.2% in Q2 and 13.1% in Q1. A look at the sectoral breakdown suggests that the gross value added from agriculture, forestry, and fishing grew quicker on a yearly basis from 4.1% in Q4 of FY22 to 5.5% in the corresponding quarter of FY23. Manufacturing registered its first positive growth rate in 3 quarters at 4.5%. The gross value added by the manufacturing sector towards India's GDP grew at 6.1% in the first quarter of FY23 and then contracted for 2 quarters at 3.8% in Q2 and at 1.4% in Q3. The most substantial development was seen in gross fixed capital formation or investment. Investment breached the 35% mark for the first time in at least 2 years when it comes to its percentage share in overall GDP. But the percentage share of private consumption in the overall GDP contracted to 55% as compared to 61.6% last quarter. Government consumption, nonetheless, continued its upward trend, claiming an 11% share in GDP this quarter as compared to 8.7% in Q3.
As far as agriculture is concerned, I think it's been robust throughout the pandemic and post-pandemic. I think despite weather vagaries, I think agriculture has stood up quite well, and that is telling you about the resilience, somewhat resilience in the agriculture sector. And then government is pushing investments. That is leading to a strong performance of investment activity and also, I think, construction activity. And services which are showing strong growth are benefiting the urban economy more than they are benefiting the rural economy because most of the services are in the urban areas.
What then are the larger implications for this surprising buoyancy in Q4 GDP numbers?
Well, I think one, it is telling you that the economy has rebounded from COVID faster than what was anticipated earlier. It reduces the permanent loss to the economy, which we had anticipated earlier at around 9%. I think that is progressively coming down. And it has also, I think, it's showing the strength of the agriculture sector, which has done well all through the pandemic and even the post-pandemic. And it's now showing the rebound in services.
While challenges persist, the financial year of 2023-24 has begun with a pickup in high-frequency indicators of the Indian economy, raising hopes of a sustained growth momentum. Collections from Goods and Services Tax or GST stood at 18 trillion rupees during FY23 as compared to 15 trillion rupees in FY22, an impressive rise of 22%. Railway freight carriage too touched an all-time high of 145 million tons in March. Digital payments or Unified Payments Interface or UPI rose 43% to 14 trillion rupees in April 2023, just as the volume of UPI transactions also rose 59% to 8.9 billion. Domestic passenger vehicle sales saw a 13% jump in wholesale dispatches to 3.32 lakh units in April. Even India's Purchasing Managers Index or PMI for manufacturing in April increased to a 4-month high of 57.2 from 56.4 in March. A number above 50 indicates expansion in manufacturing and anything below 50 signals contraction. Chief Economic Advisor V. Anantha Nageswaran said on Wednesday, therefore, that risks to India's GDP growth forecast of 6.5% for 2023-24 are now more evenly balanced than a few months ago, when downside risks to the forecast were greater. However, experts advise caution.
There are a couple of issues which seem to be a little troubling. One of the things, we've seen very strong growth, but we've been seeing consistently declining imports. Why are imports declining? Because the effect of the global commodity price decline, that was over. The second thing that we need to worry about a little bit, consumption is very weak. The question then is that unless consumption picks up, will we start running into serious overcapacity problems? The numbers don't really overcome this fear of the Indian economy still not being out of the woods.
I think there are two challenges in 23-24. One is the slowing global growth, which will spill over to weak demand for exports. And then from there, it will reflect in the manufacturing sector, which cater to the export demand. Challenge number two is that the central bank had raised interest rates to slow the economy, to control inflation. So some impact, lagged impact will be felt. So we do believe that economy will slow to 6% in FY 23-24. And even with that, India will remain the fastest growing G20 country.
The fact of the matter is that the indicators are good. But the question then is, where is that demand side going to come from? Is it going to be more investment? Because exports are not doing very much. And unless consumption, domestic consumption picks up, it's a growth story, but it's a fragile.
The latest GDP numbers, therefore, have held true to the Reserve Bank of India's predictions in its annual report for 2022-23. The RBI has also predicted that India's growth momentum is likely to be sustained in FY24 in an atmosphere of easing inflationary pressures. But experts point out that the Indian economy is still not out of the woods, and macroeconomic indicators such as consumption, trade, etc. need to be monitored carefully.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.